Good morning, guys, gals, and non-binary pals. You have attended Selectpath webinar series. Today is the 14th of April, Wednesday. I'm your host, Jake Clark. The session this morning that will be presented to you is the pros and cons of underwriting benefits on a self-insured basis. This is a topic that is being presented in the series from Selectpath on webinars. The next series following this one will be Wednesday, May 12th, and the topic will be digital virtual health tools. I do appreciate your time for joining today. We have a presentation that should take roughly 30 to 45 minutes to go through. The presentation really is illustrative on the pros and cons of underwriting benefits on a self-insured basis. It is not exhaustive. I will mention before I start, I am a certified employee benefit specialist. I am not a lawyer, nor am I a tax specialist. So if anything touches on a legal aspect and or tax aspect, it's always better to take any feedback and qualify it further from a specialist in that area. That being said, I'd like to welcome you all, and let's get started. When we're taking a look at a group benefit plan, the optimal group benefit plan approach is key to your organization for attracting and retaining and keeping your employees healthy and productive. So what a lot of people tend to realize is that a group benefit program typically can be one of a business's top 5 expenses. Now, this depends on the industry or the sector that you're in. However, when we take a look at a business, the major costs tend to be payroll, plant, property, equipment, and or inventory if inventory applies. Benefits typically fall right in or behind that. So we are dealing with a significant investment that an organization makes on behalf of the organization and its stakeholders. And the benefit plan typically represents about a 6 to 8% of payroll costs. So, if we're looking at an organization that's got a $5 million payroll, this is roughly about $350,000 a year in group benefits cost. If we break that down to the monthly cost per employee, what we typically find is that we're looking at $350 to $500 a month per employee, or about $4,000 to $6,000 per year per employee. There are some metrics that tend to back this up. I know the Conference Board of Canada has done an annual benchmarking report on group benefits a few years recently, where these metrics are echoed. But if we take a look in the context of the group landscape, there is a broad spectrum of product options and offering that are available. And when you really look at the landscape, there's a whole swath of what can be used to effectively cobble together a tailored or bespoke solution for your organization. So when you start going down the road of templated or canned or generic type of options, these do exist, of course, in the marketplace, but there are a full spectrum of solutions. Really, what the organization should be looking at is what, in the context of this group benefit plan, how does the group benefit function tie into or relate to the overarching organizational missions, goals, or objectives? How does the group benefit context align with HR functions and or compensation? And when we take a look at what the group benefit plan should be doing for your organization, it should be driving and rewarding plan members and stakeholders so that there's a continual stakeholder value loop that's being constructed. Really vis-a-vis, the employer is trying to take care of their employee, and it's the employee that often takes care of the customer of the organization. And if you take good care of your customers, typically your customers will be loyal and will return and take good care of the company. So there is this stakeholder value loop. And one thing that the Sanofi Aventis survey shows year over year is that beyond the actual cost of the group benefit plan on a per employee basis, employees do have a high value perception of their employee benefit plan. So we can look at how do we get the most optimal group program in place. And when I say that, what I'm looking at is how do we get the best outcome for the organization and all stakeholders, but also at the lowest manageable cost going forward. I do have to start out, before we look at answering that question, saying you do have to have a heightened awareness that when you're dealing with a group insurance or group benefit program, you're dealing with something that is inherently a complex product or solution that's being put in place. There are a lot of technical nuances that are involved with the design, implementation, and management of group benefit programs. In our industry, when I take a look at group benefits as an industry, there are literally over 100,000 licensed advisors in Canada. And on the opposite side of the spectrum, there are roughly only 50 in that industry that have their fellowship. So it just so turns out that Selectpath has the highest proportion of certified employee benefit specialists with their fellowship and accredited expertise on our advisory staff than many, if not most, if not all other benefit firms. So what is actually common to find for the marketplace is that someone that doesn't have the accreditation or the experience will often take a look at a one-size-fits-all solution that tends to make sense for all of their clients that express an interest in group benefits. And I'd suggest that really isn't the most cost-effective or constructive value proposition for an organization. Taking a look the other way around at your organization and then mapping out what the needs are from the organization through the HR and compensation context and what all stakeholders require is probably the best first measure, and then building around that with the most effective solutions gets you the optimal benefit program that cascades the most value to your plan members and also manages the lowest cost. So one of the things that happens in the marketplace is that administrative services only or self-insured plans tend to be seen by many that don't really understand the full spectrum of group benefits as a very transparent and low fee solution, and therefore it must be the lowest cost solution. And we see it time and time again. And many times when it's not incorporated into the appropriate context, it is not the most effective and it is not the most efficient. So back to how do we get the most optimal program in place? Well, the answer comes from not only your organizational context, but reviewing the population and the approach that best serves the workforce or the population that you've got within the plan. Typically, there's probably a need within your organization to have flexibility to align with work-life balance. There might be some organizational diversity requirements that speak to different roles, different segments of your workforce, or different backgrounds within your workforce that need to be addressed. Some organizations want a flat or equitable approach that's more simplified. And yet again, others are focused on the type of a talent that they're trying to attract or retain. And they may these days be looking at onboarding a younger demographic, which arguably don't have the same needs or desires of an aging demographic or let's just say a demographic that has more experience and expertise. So really it depends on what we're looking at, and knowing the population needs of your organization will lead you towards the plan approach and the coverage that should be in place. There is also a spectrum of risk associated with what approach an organization needs to take on their group benefit program that always needs to be factored in. If we're taking a look at silos and certain cohorts, we do need to factor everything in because all of it impacts the plan funding. So If we look at the nature of risk management, really, the larger the group, the more spreading of risk there is. This is one of the fundamental contexts of a group plan, where we're grouping people together. And the more people that we group together, the less risk there is, as we can spread that out over the population. If you're wondering, roughly where does that number, or where is the number where the spreading of risk is to a point where we should have full credibility, or be funding our program completely based on our experience. From a statistical perspective, the Institute of Chartered Benefit Analysts indicates that roughly 71 employees is that metric where we have enough spreading of risk, where both health and dental and prospectively short-term disability coverage can be self-insured and underwritten on a administrative services only basis. So if you think in that context, the smaller that the group is, or the less, or the farther under 71 plan members that group is, theoretically, the less spreading of risk there is. Therefore, there's more of a need for some form of insurance pooling or insurance factor that gets put into play to help stabilize the group pricing from year over year, and make sure that it runs go forward at the lowest long-term cost basis. So if we take a look at the nature of risk, different coverage lines within a group benefit plan have different risk associated with them. So life insurance, long-term disability out of country, that segment, we often refer to that as the pooled benefits. The pooled benefits typically have a low incidence of claims, but yet when an out-of-country claim, or when a life insurance or long-term disability claim happens, the payout can be substantial and continue for many, many years. So, of course, commensurate with that nature of risk, it does in fact require a higher level of pooling. The metric used to be if you have 1,000 employees or greater, you could self-insure the life and LTD risk for the most part. And in Canada, we actually did have a number of larger employers that did just that. However, over the last few decades, we've also had a number of employers that have gone bankrupt. If you think of Nortel Networks or Eaton's, the department store, those were two large Canadian employers that in fact did have self-insured life and disability programs that were not appropriately funded. And in fact, when the companies went insolvent, the government had to come in. So at this point in time, the majority of life, LTD, and emergency travel coverage is fully insured and fully pooled throughout Canada. Short-term disability, health and dental, on the other end, are kind of the opposite of that. We have a high volume of claims that tend to get processed, and those claims are typically smaller ticket items in comparison to life or LTD or out-of-country claims. So excluding stop loss or large amount pooling for specialty or high cost drugs, health and dental typically does have a high volume of lower payout claims, and therefore it can be tracked, and it is more stable, more predictable, and therefore does serve as a good avenue when you have roughly 71 or greater employees to take a look at self-insuring. So group benefits, again, this was mentioned earlier on in the presentation, it should help drive stakeholder and organizational outcomes. So we always want to keep that stakeholder value loop in mind. If we look at the spectrum of what do we have in the marketplace with group insured plans, well, on the one end we have fully pooled, fully insured plans. Typically, you'll find these types of programs, association plans, things of this nature, really designed for organizations that have 10 or fewer employees. And of course, these are mostly generic templated approaches where the rates are set based on the overall claims activity associated with the pool, particularly from a short-term disability, health and dental perspective. So the claims experience really is not relevant to the employer or plan sponsor. And in fact, if you're in a pooled arrangement, the service provider will not disclose the claims experience of any individual participant. They may disclose the overall pool, they may not, but typically everyone is pooled together and is protected by one another. Of course, the larger a group becomes, if you have 10 plus employees and the demographic and main ingredients are showing that the claims experience is actually more favorable than the rest of the other groups that you're pooled with, the organization will get to a point where it will start to look at a modified or fully credible approach, because why stay in the fully pooled arrangement and subsidize all the other organizations that are in that pool when you can be rewarded for your higher group count and your more stable claims, and in fact, probably lower claim per plan participant output that the plan is providing. So what we tend to see is that when organizations reach size from, say, 10 to 35 or 10 to 50, they typically move from a fully pooled over to a modified pooled underwriting approach, where a portion of the rate is set based upon the claims experience. The other portion is blended with a pooled book rate to stabilize the group. Of course, moving over to a fully credible scenario, typically if you're 35 to 51 employees plus in the marketplace, you'll start to see that the health, dental, and dental rates will be completely set based upon the claims experience. Eventually, the short-term disability will be fully credible, but both under modified and fully credible, you're not in these canned generic coverage templates. You're in more flexible coverage scenarios with more transparency, more reporting, and so really there is a scale of risk management that is in the marketplace for this very reason. Doesn't mean that your organization should be steadfast aligned that way. I have many clients that I work with that in fact have 10 employees or less that for years have had low claims. And so we have them in a more experience rated rather than a fully pooled scenario where they're subsidizing other people within that pool. When you're on an insured plan and you're fully credible, if your organization is large enough, there may be a desire and a need to keep it on an insured platform, but make sure that there's some exposure or benefit of refund accounting. And what refund accounting does is it's effectively a fully credible group insurance plan. However, if the service provider is overcharging based on the cost of the plan, and there's a surplus at the end of the year, the surplus actually credits back to the plan sponsor. Now, there are different refund or retention accounting platforms or approaches in the marketplace. Some of them will they'll call themselves a simplified retention, where they split the surplus 50-50 with the client. Others are full refund or full retention, where the client would in fact recapture 100% of any surplus that happens. And a surplus effectively is when premium is paid for health and dental throughout the year and prospectively short-term disability. If after all costs are factored in based on the claims performance, there's money left over, that's the surplus. Now, what's interesting on a retention or refund account is that if there is a deficit, in other words, the plan sponsor, the client has not provided enough to the insurance provider and the insurer has had to carry more and cover more claims, in fact, there's a deficit balance owing rather than a surplus. Under a retention accounting or refund accounting platform, the deficit is the responsibility or liability to the insurer. So it's the beauty of getting access to any surplus being credited back while having any deficits covered by the insurance function. So there are some different differences with how the costing is done on a retention accounting. Rather than having what are called incurred but not reported reserves, there's a claims fluctuation reserve. The retention charge does include the risk charge to the insurer, the profit, the admin, the commission, the premium tax, and also large amount pooling for any large claims that would be paid out on top of a predetermined threshold. So let's say if you have a $50,000 claim and your threshold is 10,000, then your group would be exposed to the first 10,000 of the claim. The large amount pooling would absorb the remaining 40,000 of the $50,000 claim, and that would not recur for future pricing forward. So what you can see with this type of approach is it's very stable from a rate perspective because the rates are held from one renewal period to the next, and the insurer provides absolutely complete full disclosure on all aspects and costings within the program. In fact, providing annual financial statements on the account. So the retention or refund accounting, depending on the size of the organization, can be a really good risk management tool where there can be upside for the plan sponsor, but limited downside. That brings us over on the spectrum, breaking away from the insured approaches over to self-insured, what we refer to as administrative services only. There are two approaches for administrative services only. There's budgeted ASO and then pure ASO. Now, budgeted ASO is what I tend to focus on for this webinar. Reason being is that it works closer to a retention accounting or fully pooled insurance or a fully credible insurance group insurance plan, in that when you have a budgeted ASO, the service provider will in fact hold the funding steady for a 12-month period. A true ASO program does not work that way. A true ASO program, the monthly funding changes based on the month before in arrears. So effectively, whatever claims on a true ASO program, the life and long-term disability and out-of-country pooled benefits will remain steady, but the short-term disability, health and dental, if they're self-insured, the funding from month to month will vary depending on what's been paid out of the plan. So effectively, an ASO plan can actually become difficult to track because you have to tabulate what in fact is being paid out of your program from a month-to-month basis. A budgeted ASO does the same function of an ASO contract, but the service provider in fact charges a levelized monthly funding amount, which gets reconciled at the end of the reporting period. So it is self-insured. It is an ASO program. Any surplus and or deficit is the responsibility of the plan sponsor. So the surplus would credit back. However, any deficit that's owing would be owed to the service provider by the plan sponsor or the employer at the end of the period. So this is true self-insurance. And the reporting tends to have on any ASO plan, whether it's budgeted or whether it's true ASO, there will be a listing of the fees that are incorporated into the claim process. So there's typically an admin fee, there's a profit fee, there's commissions. These are all premium tax. These are all broken out separately, as is stop loss insurance coverage for large cost drugs. So, we do have this spectrum, and we have to take a look when we're dealing with clients as to how the working capital of the business tends to flow. If working capital is no issue at all, then ASO tends to speak to that. Don't forget the other ingredients aside of that: organizational goals, HR function, compensation, the group context, how it's broken down, the different segments of the group. So all of these will dictate and kind of lead us to what way tends to be the most effective for a client. So that's why we always have to reconfirm, going from fully pooled all the way over to a full ASO on the spectrum, where in that spectrum makes the most sense for an organization that we're dealing with. So as I point out here in bold, there needs to be the willingness by the plan sponsor or the employer and the financial ability to assume the financial risk over assigning risk to an insurer in selecting an ASO or budgeted ASO arrangement. So when we take a look, what's really the pure advantage of a self-insured contract? Well, the pro of a self-insured contract is there is no risk charge that gets tied into the health, dental, or short-term disability costs, because the risk doesn't exist to the service provider. The risk is subrogated back to the plan sponsor or the employer, because they're assuming that risk, and therefore when they assume that risk, they're not charged the risk charge associated with it. Now, what is the risk charge? Typically, the risk charge is around 2%. It's nothing staggering. Now, that's not hard and fast that it's 2%. It depends on the service provider, it depends on the group, depends on the size, depends on the risk. But my point is that the risk charge is not an overarching, overwhelming ingredient that gets baked within an insured plan. The ASO provider does provide a claim admin fee or a processing fee along with applicable commissions, and 2% insurance tax remains applicable. There's also GST that gets added on top of the actual fees that are charged on ASO, whereas an insured plan or retention insured plan simply has HST associated with it and the 2% insurance tax. So there is no GST in an insured plan. So while you get away from the risk charge, you do pick up a little bit of GST on the fees, not on the claims. When we look at how a true ASO runs, as I mentioned before, you can have some substantial monthly cost fluctuations depending on the claims fluctuations, and it can be a challenge internally for the organization to track, in fact, what they're actually being charged or spending on the plan. So one thing to keep in mind, given the transparency of just inherently in the nature of a ASO program, a lot of agents / advisors tend to see this transparency as something that speaks better to what the actual charge is for the organization. And there's a bit of a misperception that ASO will be the savior for pricing issues. In fact, based on the month-to-month fluctuations and the tracking issues, ASO can actually require more oversight. In particular, what I've tended to see a lot of in the industry is that once an ASO approach tends to be slapped into an organization, albeit appropriately or inappropriately, sometimes the plan design itself is neglected. And regardless of whether you're on an insured plan or an ASO plan, maybe you could argue it's more heightened on an ASO plan, but if the plan design is the same and the plan design is not well managed, then in either scenario, insured or self-insured, you're going to have the claims continue to deteriorate or escalate. And the fees associated with those claims, whether you're on ASO or insured, are going to have an upward presentation on a go-forward basis. So ASO is not going to save increasing costs on your benefit plan. Making sure that the plan is effectively and properly designed in conjunction with the right underwriting approach, self-insured or insured, put together is likely going to solve that equation. So we've gone through on the insured side that the insurer assumes financial risk versus self-insured, where the plan sponsor, the employer, is assuming the financial risk. What we wanted to take a look at is, well, what are the ingredients? There are some nuances. We mentioned ASO has stop loss insurance, whereas it's called large amount pooling on an insured basis. Well, large amount drug claims have become more or increasingly prolific in the Canadian landscape. And we're now seeing in many organizations that employers can open large cost drug claims, which range from $20,000 per employee per year to a Solaris drug claim where you're looking at $1 million per person per year. So, making sure that appropriate plan design in place and or appropriate large amount pooling or stop loss is key. One thing that should be pointed out is that any insured plan, whether you're fully pooled all the way through to retention, includes large amount pooling. And large amount pooling for insured plans participate in the EP3 pooling arrangement through CDIPSI, which is the Canadian Drug Insurance Pooling Corporation. And effectively, recurring large drug claims are actually subrogated to the EP3 arrangement. And technically, the insurance provider, while they may have that large claim for the first year to 3 years, can in fact offload that ongoing cost beyond the $50,000 threshold through the EP3 arrangement. ASO stop loss does not have that function. ASO is exempt. It's not an insured contract. ASO is exempt from CDIPSI and EP3, and therefore your stop loss that you're paying for on your ASO program is going to be paying the full brunt of any large claim that's ongoing for quite some time, so long as it's ongoing, and it does not have a mechanism to subrogate any cost over the $50,000 threshold to that EP3 mechanism. So there's an inherent tendency, if you look at where large amount pooling costs are going, which tends to be up, versus stop loss pooling, which tends to be up, you're going to see a more pronounced increase on stop loss pooling than likely you will in large amount pooling under an insured arrangement. So that is important to note. What I did was I took a look and said, like, where does the rubber hit the road here, and what does it look like if we take a look at two different approaches? So I approached one of our service providers that we work with that provide not only an insured solution to the market, but also a budgeted ASO solution. And I wanted to use budgeted ASO because it better compares to an insured approach, because the funding is stabilized in the budgeted ASO. And if you take a look at this slide, what I've included on the left-hand side from Empire Life is we've taken a 53 employee group with exactly the same coverage and same claims. So these two scenarios are indicative of the exact same group. So we've taken this sample group, and on the left you see what the ASO proposal looks like, and on the right you see the insured proposal. And if I draw attention to the bottom right corner where you look at annual funding, you can see that the ASO funding is around $223,000 a year for this plan. On the right, with the insured program, the funding is around $230,000 to $231,000 a year. So as you can see, the difference when we're dealing with this level of dollar amount, the difference between the two is fairly negligible. So when we break it down on how they would work, well, what I looked at, how do the costs run together? We're on the left here. The ASO has a 7.8% fee for admin, a 6.5% deposit, which is a reserve equivalent. The trend of 12.4 and 7.9 for health and dental is the same that you see on the insured side, and the stop loss expense is 20.28%. The insured side, we're looking at a target loss of 77.9. If we subtract that from 100, we basically get an all-in retention charge of 22.1%. So if you add the stop loss and the ASO expense together, I'm just going to use a highlighter here. If we take the ASO expense of 7.8, add in the reserve, and add in the stop loss, you get effectively about a 28.08% charge for processing claims on the budgeted ASO. If we subtract the 77.9, pardon me, I'm just looking at, on the ASO, I'm looking at the ASO expense and the stop loss, not looking at the deposit, just these two. It gives us a 28.8. If we look at simply the retention charge, we're looking at 22.1. So on the health end, the insured program actually tends to process claims in dollars at a lower cost. The deposit and the reserve are the same, the trending are the same. So for healthcare, you're about 6% ahead on the insured fee basis. However, there is no stop loss or large amount pooling on dental, so the ASO tends to be about 14.3% ahead on the dental. If we take a look at just running the numbers, and I'm not going to go through this from a timing perspective, we're getting a little bit on with this presentation, but the claims that we put in through the plan were 66,250 for healthcare and 42,995. So we're assuming that this is what the plan claimed out. So if we look at the ASO versus the insured, what does that mean for your go forward funding for the next year? I actually quickly run through the funding calculations that would happen on the healthcare and that would happen on the dental side for the ASO. I basically take the claims, add the expenses, get the net funding adjustment, subtract that from the claims that were actually paid out, left a deficit on health. So we had to add additional fees for that deficit, and the balance owing was about $8,800 on the healthcare side. Inverse happens on dental, where claims paid were less than the net adjusted funding in, so there was a credit, and therefore fees need to be credited back to give us a surplus of $3,345. So we're behind on the healthcare, we're ahead on the dental on the budgeted ASO. So the year ends on the ASO owing $5,419. The go forward rates on the ASO program would be roughly $82.96 and $200 family for healthcare, roughly $41 for single, and $100 for family on dental. So that's what our ASO approach would look like for the first renewal effectively. And I use the word renewal. Renewal typically relates to insurance, but it's the go forward funding if appropriately done. So we run those same claims through the insured plan. We run through the calculations and the costings, and we see that we'd have to give about a 24.6% increase on healthcare and a 15.7% on dental. What tends to drive that up is that the reserve is being factored in at the first renewal, whereas the deposit on the ASO side was funded in at the first year. So it's a little bit, the illustration on the insured side is a little bit distorted to the higher end of what it would be at the second renewal compared to a budgeted ASO. So it places the rates on that insured side about 11% over where the ASO rates were on health, and about 17% over where the dental rates would be on the ASO. However, if we take a look at the original proposals, keep in mind that the ASO proposal that we were looking at originally came in around $230, which was about $73.50 lower than the insured. However, once we reconcile that deficit that happened at the end of the first year, the ASO plan was roughly $2,000 less than the first year with the insured plan with Empire. And the go forward funding on the ASO is roughly 6.5% increase. So we're moving to about 237.7, and the insured is up 12.5 to 260 basically. So we have about a 9% funding variance from the insured plan over to the budgeted ASO. And when we factor in the fact that the reserves have now been fully built into the insured program and therefore won't recur at the next renewal forward, and the fact that whenever an insured plan renews, it's negotiated by the advisor or broker or consultant that's overseeing the case, we typically see that when we're reviewing our plans that there are some metrics and cost factors that do need to be adjusted based on the specifics to the group plan. I'd argue that we could probably reduce the insured program somewhere between the 5 to 15% mark. So, when we factor in what happens after negotiation, that 12.5% increase that comes out of the door with Empire may actually result in a 2.5% increase, and therefore we'd be net 4.5% below where we'd be on the budgeted ASO. So really what I'm trying to say in going through this whole presentation is that there is no magic bullet. we really have to take a look at the context of the organization and the appetite for the transparency that the organization wants, while qualifying what that transparency means compared to an insured approach or a retention refund approach. But moreover, looking at the organizational goals, the HR metrics and the compensation approach and the stakeholders that we're dealing with, not only the business, but the end result with the customers and the employees, and how the organization wants to treat the employees in the stakeholder loop, and what that employee base looks like. All of these things and the plan design get factored into what the best approach would be. Of course, the plan design is a response to the organization and the stakeholders and the employees and the details therein. So, hopefully through this presentation, I've given you a pretty good run for the money on the ins and outs of both. In fact, you can have both fairly transparent. If you have somebody that you're working with that really fluently understands insured programs and self-insured ASO arrangements, what you can find with the same group is that they'll be fairly similar if they're managed effectively and managed properly. So really, it depends on what the right solution for the organization is, based on the preference of the organization. So I want to thank everybody for their time today. I know we're running towards 55 minutes here, so I'm going to wrap this up. We do have a Q&A on the side. If anyone's answered questions, we will get back to you if you have. If you do have a question on this presentation, feel free at any time to reach out to your Selectpath advisor and ask a question. They'll be happy to help you. And I want to thank everybody once again for taking the time out of their day to join us for this presentation. And again, the next one is Wednesday, May 12th on digital and virtual health tools. I'm Jake Clark. Thank you very much, everybody. Take care. Have a great day. Bye-bye.